so guys, we're going to go back to the slide, and we've kind of gone through a couple of the problems, so we're getting an understanding of how we're recording all the income tax expense, and we're showing the amount that's payable in this period, and then that amount that's getting deferred, we're showing it as a deferred payment, aren't we, on our books. And why is it being deferred? It's being deferred because we were able to take a greater write-off. Taxable income was lower this period than it's going to be in future years. Okay? So as a result of that taxable income being lower this period, but we're going to have to adjust for it in future years, we need to record a liability showing the taxes based on this scenario today. We know we're going to be paying in future years, because sometimes the greater the depreciation we took on taxable income is going to be adjusted by the book income. Does that make sense? Yes, Karen?
Yep. I just want to make sure we get this one. For 18.3, we had the non-current liabilities, or deferred tax liability for 2,100.
Okay, 1 second. Let me go here, okay? So for 18.3, yes, we...
I just wanted to ask you, so that means that it's going to be, since it's a non-current liability, it'll be paid in future years.
That is correct. That is correct. Think of it like this. The depreciation for book purposes was a lot less than what we took for tax purposes. So for tax purposes, we took a lot more depreciation this period than the book purposes allowed. So as a result, compare it to book versus tax, our income taxes was less this year, but it's going to catch up with us. And so for book purposes, we want to show that deferred liability that we escaped this year, but we're going to have in a future year. Okay? So anybody else have questions? So as we continue on with this, we understand how temporary differences in that scenario created tax-related liabilities, didn't we? Because it's something that we're going to show now that we know we're going to have that tax in the future. So we're recording it on our books as a liability. We're going to also look at where we're going to have tax-related assets on our books. Our taxes are going to be much greater this period, and so as a result, down the road where our income taxes may be less, we're going to show an asset, not a liability. Objectives of accounting for income taxes: we need to recognize the amount of income taxes that are payable or a refund for the current period, which we're doing, and then we need to recognize any deferred tax liabilities for future taxable amounts, which is exactly what we did in problem 18.3. And then if we have deferred tax assets for future deductible amounts, which we haven't done a problem like that yet. The balance sheet recognizes the future tax consequences that are going to rise as, and they're going to show it in the balance sheet. Like we showed that non-current liability as a deferred tax liability. We showed it on our balance sheet in the liability section. Now, we're going to talk about this comprehensive asset and liability approach. This requires the recognition of either the asset for taxes or the liability when there are timing differences between the accounting value and the tax value of an asset or a liability. So when we've got an asset, like we saw in those in our situation because of depreciation, when we've got an asset that we're valuing different, we need to record that, don't we? 4 principles to apply when accounting for income taxes. We have to recognize a current tax liability for its estimated income tax payable on its income tax return for the current year, or recognize the deferred tax liability or asset for estimated future tax effects for those temporary differences. measure its deferred tax liabilities and assets based on provisions of the tax law, and potentially future changes in the tax law. We did a problem like that where it changed. We thought the rate was 30 and it changes to 35%, and we have to show that change as a result of revised estimates. Also, another principle that we have to do as it relates to income taxes, reduce the amount of deferred tax assets by the amount of any benefits that are not expected to be realized. We're going to look at problems just like this, guys, okay? Hang in there with me. Deferred tax liabilities, they're going to be a liability. It's a deferred tax consequence we owe the government. We're going to owe the government money on that asset. We depreciated more of it because we were allowed to do that, but it's going to catch up with us because we're going to ultimately owe a little more down the road. So it's going to involve future payments of taxes. Income taxes are going to be payable when the temporary differences ultimately result in greater taxable income in future years. These are temporary differences. All we're doing here is with depreciation, we're going to get to have the depreciation. It's just what period are we recording it in, the amount. And as far as income, we're going to have to eventually show that income as taxable, but what period are we recording it in? Okay, let's go back. Measurement of temporary differences. Marginal tax rate is that income tax rate expected to apply to the last dollar of taxable income. That 25%, that last dollar is going to get taxed at a 25% rate, right? If sufficient uncertainty about future taxable income, FASB decided that we must establish a certain type of allowance for valuation. More likely than not that the deferred asset will not be realized. Oh my goodness. Don't even worry about that. It gets so, FASB can, darn that FASB. Okay, so, we're temporary differences, future deductible amount, measure the year in. Yeah. Okay, so let's go back here. Let's just take a look at a couple more problems, okay? So if we go to our 18.4, single temporary differences with multiple rates, okay? So here we've got, at the end of 2013, Foliage Company reported taxable income of $9,000 and pre-tax financial income of $10,600. The difference is due to depreciation for tax purposes in excess of depreciation from financial reporting purposes. The income tax rate for the current year is 40%, but Congress has enacted tax rates of 35% for 2014 and 30% for 2015 and beyond. Foliage has calculated the excess of its financial depreciation over its tax depreciation for future years as follows. In 2014, $600, 2015, $700, 2016, $300. Prior to 2013, the company had no deferred tax liability or asset. We now, based on this new just depreciation, have to prepare an income tax journal entry for the end of 2013. Okay, let's just pull back and say, okay, what's going on here? Our financial income, or book income, is at $10,600. Our taxable income is at $9,000. What does that mean? We recorded more depreciation in 2013, okay, than the straight line depreciation per GAAP. So it tells us the excess in the following years, and we now have to determine how to report this on our books. So, as you see here, 18.4, when we're dealing with the income taxes payable in this period, we've got 90, how much was it of income in this period? What was it? $18.4. Reported taxable income of $9,000, right? So we reported taxable income of $9,000. Therefore, our rate for this year is going to be 9,000 times, what's the tax rate? 9,000 times what tax rate? 40% is an amount of how much? I'm sorry, what? 3,600. And the deferred tax liability is a result here. Whoops. The deferred tax liability, they told us it's deferred 600 to 2014, 700 to 2015, and 300 to 2016. So it gave us the income tax rates for each one of those periods. So that's how we calculated this deferred tax liability of 510. Based on what's the tax rate going to be in 2014 versus 2015 and 16. Okay? Lower tax depreciation results in higher taxable income. We took more tax depreciation in 2013. As a result of taking more of it this year, what are we going to be doing in future years? We're going to be taking more income, less depreciation. Therefore, we have to defer it to those years in which our income's going to be higher because we didn't take the depreciation. We're taking less depreciation now. So we're going to have an income tax expense now of 4,110, aren't we? The 3,600 plus the 510. Okay, let's go back here. Any questions there? 18.5. Pedo Company has been in operation for several years. During those years, the company has been profitable. During those years, the company has been profitable, and it expects to continue to be profitable in the foreseeable future. At the beginning of 2013, Pedo has a deferred tax asset of $360 pertaining to one future deductible amount. So guys, what does that mean? That means on their book income, okay, or deduction book on their book income, they deducted something on their book income that we couldn't deduct in income taxes, right? So as a result, in the future, we get to deduct that in income taxes, okay? So that deferred asset is basically going to be a deduction in the future versus what they could deduct today. Yes?
So they could deduct it today, they just chose to save it for the future.
No, they couldn't deduct it today. So let's say, for example, let's say they had a big expense. They came in and they had a huge repair done. They got the invoice. When you get an invoice, what happens? You can show it as the expense and you show it as a payable, don't you? But for tax purposes, we can't deduct that, let's say, until we pay it. Okay? So in a future period, we're going to be able to deduct it, but not in this period. For book purposes, they deducted it, but not for tax purposes. Okay? So, During 2013, Pito earned taxable income of $51,000, which was taxed at a rate of 30%. At the end of 2013, the book value of the current liability to which the deferred tax asset relates for financial reporting purposes exceeded the book value for income tax purposes by $6,000. So at the end of the period, the book value of this liability to which the deferred tax asset relates exceeded the book value for income tax purposes by $6,000. We need to now prepare the journal entry to record this scenario. So as we look here, we've got here, we had a difference here of $6,000, right? The book value was a difference of $6,000. So we've got a deferred tax asset. We started the period with a $360 beginning balance, didn't we? And then we had this $1,800 required ending deferred tax asset because we took that $6,000, took it by the 30% tax rate that we currently have here. And so that $1,800 was the ending balance minus the $360 beginning balance, because it gave us that. It had a $360 beginning balance. So now we have to report this new deferred tax asset as $1,440. Okay? We also then have to show our income taxes payable, because I think they told us what our income taxes were, didn't they? Did they give us the tax? Our taxable income was $51,000, right? During 2013, Pito earned taxable income of $51,000. So we're going to show that taxable payable, income taxes payable of $51,000 times the rate of 30%, or $15,300. So that's our tax rate. And we've got this deferred tax asset showing up here as a deferred asset, but our income tax expense is really going to be our $15,300, what we're paying in taxes now, minus this $1,440 that we get to defer. So it's kind of working a little bit the opposite way. Hang in there with me. Let's look back here, and it says, show how the deferred tax asset is reported in Pito's December 31st balance sheet. So if we look at the balance sheet, we're going to have something called a current asset, and we're showing it as a deferred tax asset. Next, it says, if Pito uses IFRS, how would your answer to requirement 2 change? Well, International Financial Reporting Standards, we're not even going there. In this class, I'm not dealing with IFRS, okay? It keeps changing, and they treat it as a non-current asset, but don't even worry, I'm not asking you anything about IFRS. It's hard enough just knowing GAAP. Okay, let's move on. So basically, we've looked at deferred liabilities. Now we're going to start looking at some deferred assets. Okay, deferred tax asset. Let's look at 18.6. How are you guys doing? Is everyone following me okay? Here's going to be another deferred tax asset. At the end of 2013, its first year of operations, Beatty Company reported taxable income of $38,000 and pre-tax financial income of $34,400. What does this mean, guys? Book income is less than tax income, okay? What we're showing on our books is lower than what we're actually showing for taxable purposes, right? We're paying more now, okay? The difference is due to the way the company handles its warranty costs. For tax purposes, Beatty deducts the warranty costs as they're paid. But for financial reporting purposes, Beatty provides for a year-end estimated warranty liability based on future expected costs. Beatty's subject to a 30% tax rate for 2013, and no change in the tax rate's been enacted for future years. Based on verifiable evidence, the company decides it should establish a valuation allowance of 60% of its ending deferred tax asset. So prepare the income tax journal for this period. So let's look here at 18.6. We've got a deferred tax asset. Let me just read this again. The taxable income of $38,000, yet the pre-tax financial income is $34,400. They want to establish an evaluation allowance of 60% of its deferred tax asset. So how are we going to handle this one? What do you think we're going to do here? What is our income taxes payable? What do we pay in income taxes, guys? Pay it what? 38,000, right? Times 30%. So what's 38,000 times 30%? 11,400. What's our deferred tax asset going to be? How are we going to do that? We had 38,000 minus our 34,400 times 30%. What's that going to be? The 3,600 at 30%. 1080. So what is our income tax? Excuse me, that goes over here. The asset is going to be a debit there. What is our income tax expense going to be? Isn't it going to be 11,400 minus our 1080? Or 10,320? Okay? We're paying more income taxes today, but we're going to have this deferred tax asset for the future. Money we've already paid that gets to be reserved for the future. That's why it's an asset. We're ahead of ourselves. Then we're going to show we want to create an allowance to reduce the deferred tax asset to realizable value. So they then want us to do a valuation, I believe it said of 60%. Let's see. Based on verifiable evidence, the company decides it should establish a valuation allowance of 60% of its ending deferred asset. So what we're going to then do for this income tax expense is take the 1080 times 60%, and what's that going to be? 648, an allowance to reduce deferred tax asset to realizable value, 648. Okay? Number 2 then states, prepare the lower portion of the Beatty's 2013 income statement. So we've got to look at the income statement and look at the expenses, right? Do you see how we've got income before income taxes, financial accounting, 34.4. We're showing an income tax expense here of $10,968. Now, how are we coming up with that $10,968? The $10,320 here plus the $648 here gives us our $10,968 to then come up with our net income. Okay? Guys, I think I'm going to stay on this chapter for next week also. I just want you to know. There's just no way we're going to rush this in 1 week. Okay? You guys okay with that?
Some of them, when would the quiz be?
Next week. Is that all right with you? Okay? What? Absolutely. I want to keep going over more of these, but I just think it's really rushing it to do it this week. It just, I wouldn't want, if the roles were reversed, I wouldn't want that, okay? We need 2 weeks on this. As we move on here, so basically what we're trying to see, there are 2 pieces here. We're seeing how we took that deferred tax asset and we created to determine that realizable value on it. So we added both to come up with that income tax expense. Now let's look at 18.7. How are you guys doing right now? Okay, 18.7. How come I can't? Ah, I guess I'll. Okay. Zeta Corporation reported taxable income for 2013 of $200,000. So 2013, we've got income of $200,000. The enacted tax rate for 2013 is 40%. During 2013, Zeta became the defendant in a lawsuit. The lawsuit has not been resolved at the end of the period, but Zeta's lawyers believe, you know what, I told you we're not doing anything about contingent liabilities. We're not worrying about that one, okay? Let's not worry about that one. Sorry, scratch it. 18.7, don't look at. Okay, let's look at 18.8. We're not going to deal with any contingent liabilities. Not going to mess with it. Fund Company has been in operation for several years. It has both a deductible and a taxable temporary difference. At the beginning of 2013, its deferred tax asset was $690, and its deferred tax liability was $750. The company expects its future deductible amount to be deductible in 2014 and its future taxable amount to be taxable in 2015. So remember, when we have a deferred tax asset, because that means it's a future deductible amount that we get to deduct in the future. If we have a deferred tax liability, then that means it's future taxable income that's getting taxed in a future period. So our deferred tax asset, that we're going to actually get the benefit of in 2014. And then that liability we have on our books actually is going to happen in 2015. In 2012, Congress enacted income tax rates for future years as follows. In 2013, we've got a 30% rate, 2014, a 34% rate, 2015, a 35% rate. At the end of 2013, Thune reported income taxes payable of $12,600 and an increase in its deferred tax liability of $300 and an ending balance in its deferred tax asset of $860. Thune has prepared the following schedule. Fill in the blanks and show your calculations. So what's going to be our taxable income for 2013, guys? Let's look here. Our taxable income for 2013, it told us what they were paying in income taxes, right? Did it give us that information? Thune reported income taxes payable of $12,600. And what do we know the tax rate is? 30%? See that? So, if we take $12,600, divide that by 30%, what's our taxable income? $42,000. Okay, what is, the next one is the future taxable amount as of 12/31/2013. Okay, it's a deductible and tax difference. The company expects its future deductible amount to be deductible in 2014 and its future taxable amount to be taxable in 2015. So what do we think its future taxable amount is at the end of 2013? How do we get $3,000? We started with a $750 beginning deferred tax liability, right? Does it say $750 deferred tax liability? You see that there? We started with a $750. We added to that a $300 deferred tax liability. What does that give us now? $1,050. Ending deferred tax liability. And what is the tax rate going to be in that year? In 2000, is it 2015? The taxable in 2015. Our 2015 rate is 35%. How many of you guys see what I'm doing? So we started out with a deferred liability of $750. We added to it $300, so that gives us $1,050. And it tells us it's going to become taxable in 2015. If the 2050 tax liability divided by the tax rate in 2015 of 35% means that future taxable amount is going to be $3,000. Any questions on that? How are you guys doing? Make sense? Next, the next one we have to do is the increase in future deductible amounts during 2013. So remember, it's going to be deductible down the road, which means it's a deferred tax asset. So we started the deferred tax asset with what? $690. And what did we add to that? Did we add anything to that deferred tax asset? $860. So the $860 is the ending deferred tax asset. We started with $690. So the $860 minus the $690 beginning deferred tax asset means we increased it by $170, right? That increase of $170 divided by 34%. Why did we add 34%? What is the tax rate going to be in 2014? 34%. So it's asking us for the increase in the future deductible amount. Well, since we added $170 to our deferred tax asset, and we divide that by 34%, that is $500 here. Okay? Then our final one is income tax expense for 2013. Our income tax expense for 2013 is going to be what we started the year with, income taxes payable. We're going to add a $300 increase in our deferred liability, subtract a $170 increase in the asset to ultimately give us our $12,730. Questions, guys? Okay. Let's look at 18.9. Okay, this is really, highlight this. Tony, when you send me this, you're going to tell me 18.9 is what I'm really going to probably do as some type of problem on, okay? You already sent me?
Yeah.
Will you send me another one? Or maybe, should we make someone else send it to me? Poor Tony.
No, I was someone.
Someone else can do it, Tony. I agree. Wake up, somebody. Okay. Tanner Corporation begins operations in 2012 and reports the following amount of pre-tax financial income and taxable income for the years 2012 through 2016. So financial income means book income, tax income means government suck you dry income. Oh, I shouldn't have said that on here. Okay, so we've got 2012, 13, 14, 15, 16. Financial income, $70,000 for 2012, taxable income, $50,000. Okay? What we need to do, all the rates are going to be 30% for all the years. We only have one temporary difference and one originating or reversing difference every year. So what we need to do is prepare the journal entries for each year. So let's look at the first one. The first one is financial income of 70, taxable income of 50. Is this going to be a deferred tax asset, or is this going to be a deferred tax liability? Are we paying more taxes or less taxes than our financial income? We're going to be paying less, which means ultimately this extra taxes is going to be due in a future period, isn't it? So it's going to be a liability. Okay? Guys, look what happens in 2014. The financial income and the taxable income are the same. So let's look. For this year, it's financial income of 70, taxable income of 50. Well, if you think about it, we have income taxes we're paying on $50,000 at 30%, so we're paying $15,000 in taxes. We've got $20,000 that's going to be deferred until future periods. So $20,000 of it times 30% is 6, which means our income tax expense based on book purposes is $21,000. Okay? Now, if we look at 2013, look at our financial incomes at 85, our taxables at 75. Our taxable's less than our book, isn't it? You see again, 75 at 30%, 22.5. The deferred tax is going to be on that 10,000, which basically means our total income tax expense on book income is going to be 25.5. Right? Now, in the next period, 90,000 book, 90,000 tax. We don't have any deferred tax liability, do we? Book and tax are the same, so we're going to have our income tax expense and our income tax payable are going to be the same, aren't they? Isn't that awesome? Easy. Okay, now it starts to get a little trickier. Not trickier, we're just going the opposite route. In 2015, our financial income is at $82,000. Look what's happening to our taxable income. It's at $92,000. Okay? So our income taxes payable are going to be $92,000 at 30%, or $27,600. So what else are we going to do? Our income tax expense is going to be the $27,600 minus this previously deferred tax liability of $3,000. Because up here, do you see how we did this deferred tax liability? Okay, so we're basically, here we credited it, now we're debiting it. You see what we're doing now? Now we're debiting that deferred tax liability. Now's when we're using it. Okay? Make sense? Then if we look at 2016, our pre-tax income is 93, financial income, but our taxable income is 113. Look what's going to happen here. Our taxable income of 113 at 30% is our 33.9, but that extra 20,000 we had up here, this extra 20,000 up here, we're finally using it. So we're going to debit that deferred tax liability and show our income tax expense for the period of 27.9. Our income tax expense is going to be book income tax expense. Our income tax payable is going to be what we owe the IRS. And the deferred tax liability is going to be what reconciles book to financial, or financial tax to income tax. Okay? Any questions? How are you guys doing? Good? You want a break? Come on, guys. What's going on? No break? I just got to get a Diet Coke so I stay awake. Oh, my goodness. Anyone else want a Diet Coke? It's kind of cold. I feel like I'm going to fall asleep. I'm not. Just a couple sips will wake me up. No, it didn't. Okay. Okay, guys. Let's go back here and take a look at we're not going to worry about, honestly, guys, this valuation we did earlier, I'm not going to give you something where you've got to change and reallocate the asset. Just know that. I know we went over it, but I'm letting you know we're not going to do that on a quiz or a test. When income tax laws or rates change, we need to adjust those liabilities as a result of those. Now, guys, so we've been talking about temporary changes. Temporary changes are those things that ultimately are going to reverse themselves or adjust themselves in future years. But now let's talk about permanent differences. Differences between financial income and taxable income that will never reverse themselves. Okay? 3 types. Permanent differences may be non-taxable accounting revenues, such as revenues that are recognized under generally accepted accounting principles for financial reporting purposes, but they're never going to be taxable. Or there may be non-deductible financial accounting expenses that are recognized under GAAP but will never ever be deductible for income tax purposes. And then finally, there may be tax deductions that are allowed for income tax purposes, but GAAP will never allow them. Okay? Do you see we've got some differences here that we need to talk about? These are permanent differences. We're not going to reverse them with time once the income is recognized. It's never going to occur. So what are we going to do here? These permanent differences affect either the reported pre-tax financial income or its taxable income. Permanent differences are going to affect one or the other. Okay? Not both. It's either one or it's going to be the other. The permanent differences cause the company's effective tax rate to be different than what the tax code or statutory rate may be. Again, effective rate is going to be taking all the income taxes and dividing it by that income. And the statutory rate is what we get set with the IRS on the different codes rates. So let's take a look at something as it relates to permanent changes, okay? How are we doing, guys? Tired? Who said tired? Okay, let's look at 1812 here. Okay? 1812. Where's 1812? There it is. Okay, 1812. Here we're going to look at temporary or permanent differences. Do I have my little book yet? Or my little sheet? Thank you. So I shouldn't call on you guys since you're at the very end. Can't call on Karen because she helped me so much. Poor girl had so many text messages from me today. Boy, who should I call on? Blake? Can I call on you?
Sure.
Oh, Blake, you're such a good sport. Okay, Blake, will you read for me the 1812 and then A?
Ron has just completed his first year of operation and has a number of differences between his pre-tax financial income and taxable income. Differences at the end of 2013 are as follows. A. Ron recorded $7,000 of interest revenue on municipal bonds during 2013.
Thank you. So, Braun, they recorded $7,000 interest revenue on municipal bonds. Now, you guys might not know this, but municipal bonds are not taxable by the IRS, okay? It's basically a bond issued by a city or a state, usually a city, and they're not taxable by the government, IRS, Internal Revenue Service. But yet, for purposes of financial reporting, are they included as income? Book reporting, yes. Income taxes, will they ever be added as income? Will they ever? No. So is that a permanent difference or a temporary difference? Permanent. We don't ever have to claim income taxes on municipal bonds. So that is a permanent difference. These are things, guys, that will be good to test you on. Do you know what I mean? So know these. Who wants to take B? Jeremy?
That one's an asset, right?
It's a revenue.
Really easy.
Well, it says deferred tax asset / liability.
Okay. It's Okay, what's the deal? Temporary, for each item, determine if it results in a temporary or permanent difference. If the item results in a temporary difference, determine if it results in a deferred tax asset or a deferred tax liability. This is a permanent difference, period. So it's not going to be a deferred tax asset or deferred tax liability because it's never going to happen. Okay? So, who wants to take Germany? Who you want to take the next one?
That's exactly how you say it.
Is it?
Yep.
Good.
$50,000 of installment sales were recognized as income during 2015. They're expected to be received during January 2014. I think this is temporary.
Well, and okay, you're exactly right. Installment sales, we know, get recognized when we actually receive them. So for book purposes, they got recorded in 13. We're going to have to do taxable income in 2014. So one way you can tell this is temporary, because they're telling you they're expected to be received in 2014. Get what I'm saying? So you're right, it's temporary. And what would this be? It would be a deferred tax asset, a liability, because we are showing income on for taxes less than what we're going to be showing income on our books. So it's going to be a liability because we're ultimately going to need to pay it in the next year, right? Make sense? Yes.
So let's say the percent that you owe in taxes changes the next year.
Mm-hmm.
So the fact that you get the cash in that year, do you pay on the new percentage or on the old percentage?
On the new percentage. It's the year in which you pay the taxes, or the percentage you'll use. So B, what did we decide? Temporary differences. Okay? And it's going to be a deferred liability. Who wants to take C? Thanks.
Depreciation on machinery of $28,000 is in straight line depreciation for financial statements. Bronze tax account recorded $36,000 of depreciation on the company's tax return.
So Tony, is the depreciation expense greater for financial purposes or for tax purposes?
Tax return.
So for tax purposes, it's greater. And so as a result of it being greater for tax purposes, what's going to happen down the road? Are we going to have more or are we going to have less taxes in the future? We're going to have more taxes. You're exactly right. In the future, we're going to have more taxes. So because of that, will we have a deferred liability or a deferred asset? Perfect. Do you guys agree? Guys, he's perfect. What do I say? Tony, right on. Okay, guys? Does that make sense? Okay, so the next one here. And Tony, was that a temporary difference or a permanent difference?
It was a liability that would have been temporary.
Temporary, exactly. Who wants to take D? Amy? Does AIM want to take D? Thanks, AIM.
Ron was fined $3,000 for violating some state laws during 2013. Ron was fined during 2013 and future violations are not occurred.
So Braun got fined. I mean, he was doing something wrong. He had labor laws he screwed up on. He got fined. Do you think the IRS is going to let him write off fines? What do y'all think? No. They're not going to let him write off fines. Will they ever let him write off fines? No. Is it temporary or permanent? Permanent. Yes.
Can't you write off
Yes, but that's not a fine. Absolutely, you can write off attorney fees. But fines are kind of slapping your hand. So let's say they don't pay their income taxes in on time, and they get a fine from the Department of Revenue. Can you deduct that? No. Get it? Now, if they don't agree with that fine and they get attorneys to fight them, absolutely they can write off those attorney fees. But technically, fines you can't deduct. Because it's kind of like shame on you. You shouldn't have gotten it anyway. Get what I'm saying? I have clients, you wouldn't believe some of the questions clients ask. They'll say, you know, I got a ticket on the way to the airport to go get on my flight for work, and I should be able to write off that ticket because I was trying to get to work. Well, do you think it's a deductible expense? No. Get it? It isn't. Unfortunately, it isn't. You get a DWI fine. Do you think a DWI fine for a pilot is deductible? It totally screws their life because, you know, they have to report that to the FAA. No, but they go and hire these attorneys that try to like smooth it over with their medical. They can write that off because it's work related, but they can't write off their DWI fine. You hear it all, guys. Okay, I'm trying to think of the greatest this year. I can't right now. Okay. Who wants to take so did I answer that for you? Permanent. Okay. Who wants to take Gordon? Who wants to take F? What? Oh, I meant E.
Fielder Corporation has agreed to rent space from Brown in 2014. In December 2013, Brown received $7,500 from Fielder in advance for rent, and that'd be temporary.
Perfect. And is this going to be, how does this work? When they get that $7,500, when do they have to claim that income for tax purposes? When they get the income. So are they going to be paying more taxes in 2013 or more taxes in 2014?
More in 2014.
Perfect. So because they're paying more in 2013 and less in 2014, will that be a deferred asset or a deferred liability?
Deferred asset.
Woohoo! Maybe someone's learning. Did you get help? Okay, good. At least we're honest. Double points for getting help, or for being honest. Okay, I'm going to turn this off. I'm going to give you a little scoop. So I have this client in here. I got to turn this off before I tell you it.
What if I want to hear it when I'm studying?
No, I can't. Oh, wait, where's my recorder? Was I not using it all this time?